So what are some of the big differences between building a house from the ground up and buying an existing house? And of course, many wonder whether building a house is cheaper than buying a pre-existing home. Well, if you are considering building a new home altogether, well, then you may want to stick around, and while I break down the financial requirements and the process of what it takes to build a house from the ground up. Then you can determine whether this would make sense for you. I'm Harold Powell, a local real estate agent serving Ventura and the surrounding communities. And if you like my videos and want to stay up to date on all things real estate for the Ventura area, well, I suggest hitting the subscribe, like, and bell icon to be notified of future content. All right, let's get right down into building a house, which is very different from buying a home. Now, before you purchase the lot, you'll actually want to consult with either a local builder and/or architect to help determine the feasibility and potential costs of the building. And you may also want to check on homeowner insurance so that you get an idea how much that's going to run before the house is complete. So the other aspect is to make sure that you have all of your financing lined up before you make a purchase. So the financing is quite a bit different. It's a lot more complex, obviously, than buying a house, where you only need to obtain one loan for your purchase. Building a house actually may require several loans throughout the process, which does take a fair amount of pre-planning to be able to be financially ready for. So one of the first things to be aware of is that there is going to be a larger down payment requirement than what is typically expected for a mortgage on a existing home. Second is you can't build a house with a normal mortgage. Most buyers will actually end up with two loans to eventually finance the land and then the construction phase. So building a home involves three major steps. The first one is buying the land. The second one is funding the construction. And then the last step would just be arranging for long-term financing of the property. So there are three major milestones, which in theory could, again, require three separate loans for the process. There is the loan to buy the land, and then there's also the loan for the construction phase, and then again there's the third loan for the long-term 30-year mortgage after the construction is complete. So you can see that this process is going to be a bit more complex and requires a bit more planning than buying an existing home. So let's first take a look at the financing of the land purchase. We'll assume obviously the land is typical acre or less than 10 acres. And the first thing to understand is the difference between an improved lot and an unimproved lot. An improved lot, it typically has the water and electricity up to the property, and an unimproved lot is typically more remote without water or electricity. And in this situation, the loan to value is usually 5% lower or requires more money down. So, for example, an improved lot with a minimum down payment would be about 20% down, while an unimproved lot would be about 25% down. And this percentage will also depend on the cost of the lot. The higher the cost of the land, then the greater percentage down payment that will be required. So let's say a $300,000 lot may require 20%, while more expensive lots may require 25 to 35% down. Now, once you close on the purchase of the lot, you'll actually begin to pay principal and interest on this initial loan. Then after that, you'll be looking at getting a construction loan. The construction loan is actually going to be considered a short-term loan, typically lasting 6 to 18 months. And as the name implies, this loan is used for the construction phase of the property. So what you do need to be aware of is the construction loan lender wants to be a first trust deed holder. In other words, they'll want to be in first position, which will require the landlord to be paid off. So when a construction loan is funded, the initial loan will actually go towards paying off the existing balance that was created from the land loan purchase. Now, typically construction loans are just only interest only, so you're not paying anything towards a principal balance like you would on a mortgage. And the construction really works similar to like a line of credit. So as you draw funds for the construction, they'll actually pay interest on the money drawn for the different construction milestones. So the construction phase actually has a lot more moving parts, such as you have the architect, contractor, subcontractors, and materials, and a lot of different moving pieces that can take place within a 12-month time frame. So let's break down the construction process. So once you have purchased the land, hired your builder, and have your house plans, you'll actually be able to submit an application for a construction loan. So the difference between a typical mortgage approval, where you'll need typically your credit and your debt income approved, the lender will actually have to approve also the builder plans and the builder, the budget, in addition to your personal finances. Now, typically these lenders will want to see that you're putting between 20 to 25% down. So you'll be giving a 75 to 80% loan to value to build your house. And then once you get the lender's approval, then you'll actually be able to close on your construction loan. So after you close on the loan, the lenders will issue draws of money to you as the construction is completed. Now, some lenders will actually have fixed timelines in the construction to where they will actually issue you the ability to get draws of money. Otherwise, some lenders are going to be more flexible, and they'll let you kind of pick and choose how much and when you can draw funds. Now, once the lender will verify that the work has been done, they may allow you to take the first draw to pay for all that material and the work done up until that point. So there's really one thing that I want to mention that can get overlooked when you're building your own home, which is the cost of covering the construction payments while covering the cost of your existing mortgage or even rental payments. So this also means you will need to qualify for the construction loan while making payments on an existing home. So for this reason, some homeowners elect to sell their existing home during this time to free up additional cash and make it easier to qualify for the construction phase. Sometimes there can also be cost overruns, so having additional cash can come in handy. Now, once you have your certificate of occupancy, you can actually obtain permanent 30-year financing at that point. Now, the nice thing is some lenders will actually provide construction financing, will also offer a loan that can convert to permanent financing upon the occupancy permit. So you'll not need to qualify again for the permanent financing since the lender has already qualified you when you applied for the construction financing. So this makes the transition from construction to permanent financing much, much easier. Well, I hope you found this video helpful, and if so, give it a like. Thanks.